whether it's their education, into their business, into things that they control. And I think you're doing a disservice by telling people to not invest into themselves. So what I tell my clients when we begin to work with them is, we are not an investment company. We don't tell you how to invest. We don't teach you how to invest. We teach you how to become really good savers and how to protect the assets that you have from the things in life that we don't have control over. So I think the conversations that you might want to have are conversations around where are places that we can store capital that could be stored in a manner that we don't have to worry about the money not being there when we need it the most. How can we accumulate assets in an uncorrelated bucket that's not tied to the volatility of the stock market, the volatility of even the real estate market, or the volatility of the United States economy? How do we store capital in a manner where we're not going to have erosion from taxes? We're not going to get a 1099 at the end of the year for the interest that we're earning on the funds. And then talk about how you can begin to store capital that will continue to achieve your goals, irrespective of some of the things that you don't have control over. What if there was a lawsuit? What if you're not able to put money into that bucket for 12 months because you're out with a disease or you're sick, if you're injured? Or if, God forbid, tragically something happened to you, how does your family still meet those goals of sending your children to college? And there's not a lot of places to park capital that could achieve many of the things that we just mentioned. Now, the goal is not to put every dollar you have into a life insurance policy, because anything you oversubscribe to could in and of itself fail. But I think it's important to have a bucket of money that achieves some of those things that we mentioned. And I think you have to be open and confident in having a conversation of the people that you work with that understand that protection is, if not one of the key elements of a proper savings plan to accumulate capital.
Got it. And one of the things that I think, Joe, that I really liked about our conversations was when we looked at potentially adding additional policies for myself, what you basically said is basically you want to make the policies almost free for me. Like, I'm going to evaluate your entire financial picture. We're going to see, can we pull a little bit from here and here where you're not adding an extra $5,000, $10,000 a year. What you're doing is you may be reallocating some of your additional resources. What is your strategy when it comes to that? And can you give an example? Let's say someone comes in and they're a high net worth individual. Sure. Where are the common places where you could usually find the savings for them so that they could maybe get a policy like this?
Absolutely. In many of the financial things that we do in life, there's inefficiencies. There's things that we do every day that erode capital, either by default or design. And money, we like to describe money where it should be in motion, like physics, where the financial institutions teach us the opposite, whereby they want an asset to be at rest, as we like to say, which is that you put money in a drawer and you leave it in that drawer for a period of 10, 20, or 30 years. But if you look at simple physics, the law of motion, that an object in motion continues in motion. So if money continues in that same line of motion, we then start to look at money a little bit differently and say, how can we have money work in coordination? If money works in coordination with other dollars, the output could be greater. So an example of that is, what is a client doing today that might not be the most efficient thing for what they're looking to accomplish? What are the positives and negatives of that financial decision? And is there something that they could be doing that's more optimized with those dollars, that puts money back into their balance sheet, that gives them the ability to take advantage of the velocity of money? And I'll give you an example. Let's say a client comes in and they refinanced their house during the pandemic with low rates, and they took a 30-year mortgage at 3%. And they went on a calculator and realized that they could save a couple of $100,000 of interest by sending an extra $500 or $1,000 a month towards that mortgage payment. They are going to save money and interest if they prepay that mortgage payment. But we want the client to understand from more of a big picture what else is happening in that scenario. As an example, as they prepay that mortgage, they might be losing a valuable mortgage interest deduction that they have. As they prepay that mortgage, looking back in hindsight helps us make this decision a lot simpler now. They might have to refinance and get approval to take that money back out in the future, and that might have to be done at a higher interest rate. They might be prepaying that mortgage, and they might not have proper protection from death, from disability. They might not have adequate short-term savings. So we always want the client to be in a position where he has the maximum amount of leverage, liquidity, and control use of their dollars. And when we work with a client, we look at all of the different ways that dollars are sliding through their fingers, either inefficiently or ineffectively. And we look to take those dollars and have them get back onto the client's balance sheet so they could control it and not relinquish control to the financial institutions and the government.
Got it. And one thing, I guess, on this slide that you have up right now, you say that access to 95% of cash value. Typically speaking, on these type of policies, when do you usually see that kind of access? Is it in the first year, the second year, third year, just so people can have some kind of frame of reference?
So that really depends on how the policy is structured from the onset. There's ways that you can overfund policies. And I know you've learned about like the infinite banking concept where you've got a lot of access to cash in year one. Most of the policies that we structure are not that way. We try to make it where our clients have a lot of access to the capital inside the policy after the second policy year. There are some policies that you don't have access to the cash value for the third or fourth policy year. So that really depends on how the policy is structured. And based on what the client is looking to accomplish, you could work with the client and customize a policy to get cash value where you need it to be at a certain period of time.
Got it. And you mentioned infinite banking concept. How is this approach different than the infinite bank concept?
The way I see infinite banking concept, I don't think it's a bad tool. It's not something we actively practice in our company. And I think that is because the infinite banking concept puts an over concentration on the utilization of cash value inside of the insurance policies in the early years. My research has always shown that the infinite banking concepts look really well when you're looking at models of males or females at the age of 30 years old and maximizing cash value in the early years and death benefit later on. A lot of the folks that we work with in our practice happen to be a little bit older than that. And when you start looking at having less of a death benefit over the first 20 or 25 years of a policy, we want to make sure that the client has maximum death benefit and understands the value of the cash value inside of those policies so they can truly get the benefits of not only the internal returns of the policy, but the eternal and the external returns.